There's a lot of buzz around cryptocurrencies, but many people don't understand how they work. 3 industry experts and a skeptical economist explore this burgeoning technology's past, present and future in this masterclass. The series begins with an overview of the cryptocurrency landscape, including proof-of-stake, Bitcoin's white paper and non-fungible tokens, NFTs. Zhao then dives into the underlying crypto concepts that enable these innovations, such as digital scarcity and blockchain validation. What is crypto? Cryptocurrencies have gained popularity in the investment world due to their high returns, but they also come with significant risks. The value of cryptocurrencies can fluctuate rapidly, and some investors lose money when they invest in them. It is important for anyone interested in cryptocurrency to understand what cryptocurrency is and how it works before making any investments. Crypto is a digital currency that uses encryption to work. It is not backed by any central bank or government, and it operates through a decentralized network called a blockchain. Blockchain technology makes it impossible for someone to spend coins they don't own or to double spend their coins. It also prevents hackers from corrupting the blockchain by stealing transaction records. A cryptocurrency's value is determined by the market, meaning that it is worth what people are willing to pay for it. This is unlike national currencies, which get their value from being legislated as legal tender. Cryptocurrencies are considered a medium of exchange, and they can be used to buy goods or services online. There are many different types of cryptocurrencies, and new ones are being created all the time. Some cryptocurrencies have real-world applications, while others are used as speculative investments. Some of the most popular cryptocurrencies are Bitcoin, Ethereum, and Litecoin, but there are many more. In addition to being a medium of exchange, some cryptocurrencies are also seen as a store of value. However, there is some concern that the large fluctuations in price of cryptocurrencies make them less effective as stores of value. Cryptocurrencies can be purchased on many websites and through some physical stores. They are stored in a digital wallet which can be accessed with a computer or mobile phone. The wallet is protected by a password, and there are tools to help you keep your crypto secure. However, it is important to remember that cryptocurrency is not insured against losses or thefts, and it is a good idea to diversify your portfolio. What is blockchain? Blockchain is the technology behind Bitcoin and other cryptocurrencies. It's also one of today's top tech trends, and it has a lot more to offer than merely financial transactions. The blockchain is a distributed database that records transactions in a permanent and irreversible way, making it a powerful tool for safeguarding data in any industry. It's most famous for its crucial role in cryptocurrency systems, but it can also be used to make record-keeping in any industry immutable, meaning that once data is written to a blockchain, it cannot be altered retroactively. This is why blockchains are considered a massive improvement over current methods for record keeping. They slash transaction time from days to seconds, reduce or even eliminate bank transfer fees, and require fewer intermediaries to verify transactions. The blockchain is composed of a chain of blocks, each of which contains a set of transaction data. Each block is cryptographically secured and linked to its previous ancestor via a cryptographic hash value. The information on a blockchain is shared between the participants of a network known as nodes. The nodes are incentivized to update the blockchain with new transaction records and are responsible for maintaining a consistent, accurate version of the ledger. Blockchains are secure because they operate in a decentralized manner, and all the nodes have full access to the same copy of the blockchain. Unlike traditional databases, blockchains are a form of distributed ledger technology, or DLT, which makes them highly resistant to tampering and hacking. A blockchain is a digital log of executed transactions that is maintained by a community of participants on a public or private computer network. The nodes that participate in a blockchain are called participants or stakeholders, and they are incentivized to keep the blockchain updated with new transaction records through either proof-of-work or proof-of-stake algorithms. Proof-of-work is an algorithm that requires participants, called miners, to solve a computational puzzle in order to create a block. In return for their efforts, they are rewarded with a block reward. Proof of stake is a different approach to securing the blockchain that doesn't involve mining, but instead rewards nodes that lock up some of their cryptocurrency for a certain amount of time. What is Bitcoin? Bitcoin is the world's first decentralized digital money. Created in 2008 by an unknown entity using the pseudonym Satoshi Nakamoto, it's a network and cryptocurrency that allows people to transfer value from one person to another without the need for centralized intermediaries like banks, credit card companies, or payment processing firms. The Bitcoin network uses cryptography and blockchain technology to verify transactions. It's open source and publicly accessible, meaning anyone can participate in the network. Bitcoin is used as a medium of exchange, a store of value, and as an investment. The value of a single Bitcoin can be volatile. Its price has risen from less than a cent to tens of thousands of dollars and has been subject to wild fluctuations. This is because investors use the currency as a hedge against inflation and other economic challenges. Investors can also buy and sell Bitcoin on several open crypto exchanges. Every transaction involving Bitcoin is recorded on the blockchain, which is a public record that's similar to a bank's ledger but is not owned or controlled by any company or government. It's maintained by a community of miners who verify Bitcoin transactions. Bitcoin can be stored online in a virtual wallet with a public key that can be accessed by anyone and a private key that only the owner can access to retrieve their Bitcoins. The blockchain is an essential element of the Bitcoin network and allows for fast, secure, and transparent transfer of value. It also eliminates the need for centralized trust in financial systems, opening the door to more open and efficient global commerce. While Bitcoin is the most popular cryptocurrency, there are thousands more that operate on different networks and use different blockchains. These other cryptocurrencies can be traded on exchanges alongside Bitcoin and can be used to make purchases or as a store of value. Their prices can be volatile, with some having a value greater than gold or even the US dollar. They may be backed by real-world assets or simply be speculation with the hopes of making a profit. What is Ethereum? Ethereum is a blockchain network that lets you build applications and program the smart contracts that run on it. Its native currency is Ether, which you can earn by contributing computing resources to the network, mining. Ethereum builds on Bitcoin's innovation by adding a scripting language for programming and making it programmable, allowing you to build communities, applications, organizations, and digital assets that are decentralized, secure, and uncensored. It is the foundation for a booming digital economy, bold new ways for creators to earn online, and more. It's open to everyone, everywhere. All you need is an internet connection. Cryptocurrencies like Ethereum are gaining popularity as a way to store and transfer value securely online. But there's still a lot of misunderstanding about them. Some people call them scams or get-rich-quick schemes, while others swear by their potential to revolutionize the world. Most cryptocurrencies use blockchain technology to process and validate transactions. A blockchain is a public record that contains data about all the previous transactions made on the system. It's secured by a network of automated programs that work together to verify the accuracy of transaction information and ensure no one can change or delete any past transactions. The blockchain that runs Ethereum was created using a special algorithm called proof of stake. This allows miners to verify blocks by putting their own coins into a pool with other validators. They then receive a share of the block rewards as well as a proportional portion of the network's overall computational power and storage capacity. Like other cryptocurrencies, Ethereum has its own set of risks. For instance, hacking and theft have occurred on the Ethereum network. A major incident occurred in 2016 when hackers stole $50 million worth of the cryptocurrency DAO tokens. This led to a split of the network, which is known as a fork. Another potential risk is that Ethereum's smart contracts can be exploited for malicious purposes. However, these attacks can be detected and stopped thanks to the security features built into the Ethereum platform. These include a built-in arbitration system, a decentralized dispute resolution service, and a range of other safeguards to protect users.